Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here on the Smart Investing Show. We got some great things to talk about here in the beginning of the show. Talk about millennials. Well, are a little gun shy on buying a home, but we'll tell you they have good reason to be concerned, and we'll explain why that is. Better than expected inflation fuels the market higher. And then on, Friday, the Supreme Court ruled against TikTok and why you should agree with them. We know TikTok's very, very popular, but we'll tell you why you should agree with them. And then with me is Chase. Chase, what companies we covering today?
Yeah, so companies we're going to take a closer look at today is Moderna Inc., Signet Jewelers, Teladoc Health, and then this company, I never heard of it, but they're a chip company. It's Corvo Inc. There's actually some activist investment in that company. So we'll take a closer look at those items, those companies, break down the fundamentals, give you an idea of what we think about those companies. We think it was buy, sell, or hold based off the valuation ratios, the balance sheet, seeing the data that we're able to take a quick look at here.
You know, I've seen Corvo before. It's a name you just don't forget because it's such a quirky name. You know?
I know. Yeah.
Well, let's talk about the millennials are a little gun shy on buying a home, but they do have a good reason to be concerned. Looking back 30 to 40 years ago, when families purchased a home, they did it as a place to raise a family, and they weren't so focused on how much money the house be worth in the short term. Many times now people look at their house, what's it worth in 6 months? So they didn't focus on that before. Millennials who were born between 1981 to 1996 and are now between the ages of 29 and 44 years old are old enough to remember the 2008 Great Recession. 2008, there were 2,330,483 foreclosures, roughly 3 times 2006, when the number was 717,522. If at that time, the young millennials who were between the ages of 12 and 27 were not affected personally by a foreclosure, well, it was likely they knew somebody who was.
Obviously, I'm in the millennial age group, and I didn't lose a house during that time period because I was living at home with you guys. So,
yes, and I paid the mortgage.
I didn't have to worry about it, but I do again remember the difficulties that people went through, and I remember the foreclosures, and obviously studying history, how hard it was. But fast forward 12 to 13 years, and now millennials like myself have experienced a rapid increase in housing prices that is essentially unprecedented. Experiencing such a wide swing in boom and bust cycles is etched in some of these millennials' minds. By the time baby boomers hit age 30, 52% were homeowners versus 30-year-olds today at only 43%. Now, it doesn't really sound like a huge difference, but obviously 52 to 43%, you go across the country, that's a ton of people that are not homeowners at that age versus, again, the baby boomer demographic. Surveys show almost 50% of millennials have stated that owning a home is more trouble than it's worth, which is nearly double the feelings of Gen X and baby boomers on home ownership. If millennial home ownership continues to decline, we could see an oversupply in future years, which would probably mean a fall in housing prices.
Yeah, and it's so difficult. Somebody thinks that buying a home is the best thing ever, and and it's a good thing. I don't say it's a bad thing, but there are people that are afraid of it, and I've often said that when you buy a home, people forget about all the expenses, the insurance, which right now in California is crazy. Property taxes are crazy. Repairs, try and get something done. And I did finally buy a home. I kind of regret buying it because I bought it. The jacuzzi went out.
Yeah,
$2,500 to replace the pump on the jacuzzi. I mean, the expenses you have, and maybe if you're handy, it's okay. But I'm not handy. I'm going with numbers. But there's so many expenses you have that people don't think about, and that's why I think some millennials are saying, "No, I don't want the hassles," and I kind of agree with them.
Well, part of me wonders if the numbers are lower as well, and I don't have the exact numbers, but I know people have kind of delayed having kids. And as you kind of talked about earlier, baby boomers would do it as a place to raise the family. And, I have one daughter and another daughter now on the way coming in June. And I'm looking at, I want to buy a home because it gives me a little bit more flexibility to do what I want. But I'll tell you, when I was single and I lived in an apartment, that was great. It was so easy. I don't need a 3-bedroom home when I was single. So I wonder if the part of the reason as well for the delay in home ownership is, again, the delay in kind of life events that millennials are witnessing. So there's kind of some interesting numbers there. And as you said, I mean, the housing affordability has also become a huge problem. Maybe people want to buy a home, but they just can't afford one, especially here in California.
Yeah, so it's something that, again, could slow down the housing market. And yes, I do believe housing can be a great investment maybe on the long term. But this short-term thing of expecting to make a profit in 2-3 years, I do believe flipping homes, I think that's pretty much over unless you can add some value to it. But it's I think millennials are smart to be gun shy because they've seen what really can happen.
Well, and I think it's being gun shy, but also I think people need to be realistic. I mean, don't expect to buy a home and then it's going to – I mean, you've seen some homes go up like 100% in the last 4 or 5 years.
Right.
I don't think that's going to happen again, I mean, it's crazy how much they've appreciated. You need to be realistic. As you said, buy it as a place to raise a family. Buy it for those reasons, not because you think you're going to, again, flip a home again and get this huge return on it. I'd be shocked by that. The housing affordability, it'd be impossible. I mean, it's already very challenging. It'd be impossible if we got another 100% gain in housing prices over the next 5 years.
Yeah, that's impossible.
And again, that was a little bit of a over-embellishment, but again, just being realistic is important.
Yeah, I mean, we always talk about the affordability, which is very important. Housing can't increase that much more because nobody can afford it. So that's a big thing. Speaking of that, let's talk about better than expected inflation, which fueled the market. The Consumer Price Index, also known as the CPI, showed inflation was up 2.9% compared to last year. While this was in line with expectations, it was the core CPI annual rate of 3.2% that beat the expectation of 3.3% and likely is what excited the market. This report followed the Producer Price Index, which was largely in line to slightly better than expectations. The annual rate for both headline and core PPI rose 3.3%. Looking closer at the CPI, shelter, continued to be the heavyweight considering it makes up almost about 1/3 of the CPI, while it registered the smallest one-year gain since 2022, January 2022. It was still at a high rate of 4.6%.
I think that's interesting here, but it's important to point out that if shelter was excluded from the core CPI, the annual inflation rate was 2.1%, which is right in line with the Fed's 2% target. I believe there will be a lot of movement in the various price groups this year, especially with new government policies in place. With that said, though, I do believe that it is much more likely we continue to see a movement towards the 2% target rather than seeing a sustained reacceleration in inflation. I don't think we're going to go back to 4 or 5% inflation, especially at a sustained rate. I think, again, it's possible we continue to march lower, maybe at a slow pace, but I still think marching lower is more likely than marching higher. This does lead me to believe that we will not see the Fed hike rates. I was actually shocked that there were some market pundits that were like, we could see Fed hike rates this year. And I was like, I don't think we'll see that. I mean, we just started rate cuts.
Right.
And I do think it is still possible to see a couple rate cuts actually come December 31st, 2025, if inflation continues to move lower. And I mean, we've talked about the shelter index, I feel like religiously now for the last several months.
Hey, if you're going to bring it up, I was going to bring it up. Go ahead.
It's got to go lower. When you look at the year-over-year actual rent prices, they're not growing at 4.6%. I mean, some of them are negative to flat. I mean, it just doesn't make any sense to continue to see this. And again, if you strip that out, we're right near that core target for the Federal Reserve.
And one thing we could see, and we've talked about the tariffs before, is that if the tariffs do linger, we could see a slight boost in inflation. But as you talk about, the lingering effects of inflation will not be there. So I don't see any reason why they would raise interest rates. It could scare the market like, inflation's returning, but we've got good numbers. And you're so right, Chase. You back out the shelter, we're right where you want to be at.
Yeah, and everybody, inflation's still a big problem. And I'm like, Is it though? I mean, and don't get me wrong. I don't want to, I want to sympathize with people who go to the grocery store and see these high prices, and it is hard to buy, groceries and so forth because they have gone up so much. But again, inflation looks at year-over-year price increases, not comparing prices to 2019. This is again 6 years later now that we're looking at. So I just think that inflation is not as big of an issue as some people want to make it out to be. And especially from the perspective of potentially needing rate hikes, I don't see that coming. I mean, we would need to see some serious increases in prices, I think, to have the Federal Reserve reverse course and hike rates. Not to mention, and now President-elect, soon-to-be President Trump come the 20th, he's not going to want the Fed to hike rates.
No.
He's very against that.
Very against that.
I'd be shocked if we saw a single rate hike come December 31st.
Chase, last night I spoke at a financial summit, and I was the last speaker, so I listened to other people speaking. And there's people out there, this one was trying to scare people about inflation. Like, you go to the store, and this was her quote, you go to the store, and you're paying $10 for a dozen eggs. I'm thinking, lady, where are you shopping? I mean, I know they're expensive, but I've never, are they $10 when you go to the store? I'm not seeing $10 for a dozen eggs. And we do shop at Costco. But,
yeah, I'm not sure.
Yeah, and I could be wrong, but it's just like, and the whole thing she was saying was trying to scare people on inflation. If you dig into the numbers, inflation is not bad, and why that's so important is that we see interest rates at the worst stabilizing, and perhaps getting a couple of cuts this year.
Yeah, and very importantly, I don't think, again, that's going to be a big positive necessary for the 10-year Treasury and maybe not even 30-year fixed mortgages, but, it actually could hurt people if, again, they cut rates. It could lower those savings accounts, money market accounts, T-bill rates on the short end of the curve, but I think it would be beneficial for business and some rate-sensitive sectors as well in the stock market.
And, you're right. Sometimes that cutting rates hurts people more, especially if you're a senior, because they're invested in CDs and short-term instruments. It hurts them more. And then the long-term rates stay the same or go up a little bit. It's going to not help them. Yeah. So it's a bad situation.
Good for banks, which we saw this last week, and they had some great numbers.
Yes, banks. And we talked about, I think, last week that banks, 2025 look like could be a place to be. But we did that last week. So if you missed it, you can always listen to our show on podcast. Go to our website, smartinvesting2000.com, and you can listen to the podcast from previous weeks as well. But let's move on to the Supreme Court ruled against...
Oh, I'm going to cut you off there.
Sure.
It's in our newsletter this week.
Oh, it is?
Yeah,
okay.
so...
All right. Well, then sign up for the newsletter at smartinvesting2000.com. You can read it right there.
But you can also listen to this podcast later.
Yeah, exactly. You can do both. The Supreme Court ruled against TikTok. Why you should agree with the Supreme Court. And by the way, the Supreme Court unanimously voted for this. TikTok, well, it's very popular in America with 170 million people in the United States using the app. Now, I know many people love TikTok, but they don't understand what the Supreme Court is seeing and why it unanimously confirmed the blocking of the app. It's important to understand the Communist Party of China ultimately has control of TikTok, and that could be very dangerous. And it believes it was driven by, the whole party was driven by Marxist-Leninist ideology. The party believes that the CCP should silence dissent and restrict the rights and freedoms of Chinese citizens. This includes, and listen to this is what you're looking at China. This includes population control, arbitrary detention, means they have no reason, they can still put you away, censorship, forced labor, and very, very important here, pervasive media and internet censorship. Pervasive meaning they can make the media say what they want to say to make the government look better. Do you really believe that China is our friend and they should be able to obtain data, which they do on all the people using TikTok in the United States? Keep in mind that China does not allow Facebook or Instagram in their country. We would not let...
Yeah.
I know. It's kind of amazing when you read this stuff. We would not let China own any of our major broadcasters because the influence media can play, and now social media has that power that broadcasters used to have.
Yeah, I mean, I know a lot of people go to social media to get their news. So, I mean, it is a concern that I think people should think about. And also, too, you got to consider China on a very low level begins to convince people, let's say, and this is an example of some of our concerns, but they begin to convince people in the U.S. that it would be a good thing for China to take over Taiwan, just kind of by that subliminal messaging. And subliminal messaging is a lot more effective than I think people, no, I'm not subject to it. And then all of a sudden you realize that slow drip. People can be convinced this way, and this is an exact problem of how, again, China can maybe use this platform to convince people that, yeah, it's a good thing for China to take over Taiwan. Then, when they actually do invade Taiwan, there'd be a backlash in the U.S. of people who are siding with China against our government, trying to keep Taiwan out of China's hands. Taking over Taiwan would give China much more control and leverage over the United States. Think also about younger people today who post stuff that is there forever. And when they are older, it could be used against them as leverage. This could include future military leaders, perhaps members of our government, or anyone else that when they became a more mature adult, they would not want those old posts to be released. I, for one, hope that TikTok is banned here in the United States or that it is purchased in full by a U.S. company. At this point, though, China does not want that to happen because they do want to control the data and have access to it. And, you know, it's just something that we have looked at. And, you know, I was talking to you about it today, and I'm like, I kind of see the point of maybe allowing TikTok because are we any better than China because they banned Instagram and Facebook, and now we're going to ban TikTok. So we're just like China. But the big thing, and I think my big concern that you brought up, was the media. We would never allow China to purchase Fox News, CNN, CNBC. Right. That'd be a big problem. I can now see with social media, is it much different than those major news outlets because that's where people get their news nowadays.
Right. And I'll push back on you a little bit because our government is not like the Communist Party. We are not going to detain people for no reason, no censorship, no forced labor. People forget what communism is. And China is still a communist country, and they can pretty much do whatever they want. So here in the United States, we would not be using that data the way they would. China would use it against us. And again, they're smart people. I'm sorry, they're smart people, and they will find a way. They want that data, to use that data, and I think they really would be using things to kind of slightly suggest things and make things sound good. And they can write things, and you don't know it. And before you know it, like, yeah, I think China's a pretty good country.
Well, I'm just saying in a perfect world, you know, it's kind of like the whole concept around trade. We should have free trade where we shouldn't have to use tariffs.
Right.
We shouldn't have to put restrictions on other countries. But if they're doing it to us, now we have to go back against them. So, I mean, that's kind of where I'm saying it's like, well, are we any better than China if we now start doing that? But there's a lot more, I think, concerns to the equation that must be considered. And I can, again, see why there is a big danger to allowing TikTok long term. Doesn't mean that, you know, something major is going to happen tomorrow. But, again, it's a long-term investment for China. I mean, what they have, the plan was like 2050 or something was China's plan to kind of take over the world, essentially.
That's their, and they're can be
thinking
using
long term.
Yeah, they can be using things like this to do it slowly, and before you know it, you wake up like, what happened? And I'm disappointed in President-elect Trump because before he was against TikTok, now he's for it. And I don't like the flip on that because, and I think he may be using it as trying to negotiate for the tariffs that, well, we don't do that because maybe the tariffs won't do well. But it's not a good thing. And the thing, too, you hear about, well, we can have somebody else buy it, but the Chinese government still wants access to the companies, to the algorithms and the data where they still have that. They won't let that go as a big problem.
Yeah, and I mean, kind of bring this full circle, too, to obviously the investment side of the equation. I was thinking about this. I still don't know if this is going to be a huge benefit to Meta or Alphabet. I don't necessarily think additional dollars in a major way will funnel through from where TikTok is getting advertising. I know people are like, oh, this is going to be huge for Meta. I'd kind of push back against that a little bit. I don't think you're going to see a huge change. I think people might allocate a little bit more there, but I think it'll be incremental. I don't think it'll be a major shift.
And I think people are already advertising with Meta and actually YouTube's another one, not a lot in China. They're already using that advertisement there. So I don't think you'll see a big bump there either. But I really want this stopped. And I don't care what President-elect Trump says. This is not a good thing long term. And maybe he has a different plan. But,
I'll hear him out. I'm curious what his thoughts are.
Yeah. I think he's wrong, whatever he says, because I don't want China having our data.
He has a lot more data than we do. So I'd be curious to hear what he's got in the back of his mind.
China is still communist.
Well, I know we got to move on to Harrison here. So,
is he waiting? Okay, yeah, let's move on. Oh, and I did want to promote the newsletter. What else is there? Forklifts have been around for over 100 years, but they may be gone in the next 10 to 20. Times are not looking good for American farmers as they see declining profits. Investing in big banks in 2024 paid off well. Will continue in 2025. Who will be running Berkshire Hathaway when Warren Buffett passes away? And are you feeling pressure to tip at restaurants and elsewhere? Don't worry, you're not alone. This is all in the newsletter. Go to our website, smartinvesting2000.com, smartinvesting2000.com. Right in the middle of the page, you'll see the newsletter. Sign up there, and you'll enjoy it. And also, you can see it on YouTube as well. Go to YouTube and put in the Smart Investing Show, and we do all these on video for you now as well. Well, time to talk about financial planning. For that, we turn to our financial planner, CFP Harrison Johnson, talking about navigating capital gains and IRMAA. Harrison, how you doing?
I'm doing well, guys. How are you doing?
Good. I just realized I've been spelling IRMAA wrong. I didn't know it was 2 A's. I thought it was 1 A.
It stands for Income-Related Monthly Adjustment Amount. Amount is the second A. So, yeah, IRMAA.
Okay.
IRMAA.
Well, what's going on there?
If you're on Medicare or will be within the next 2 years, you want to keep an eye close on your income because not only do you have to pay federal and state taxes on it, but you could also be forced to pay higher Medicare premiums because of it. This is called IRMAA, which stands again for the Income-Related Monthly Adjustment Amount, and your modified adjusted gross income, or your total income, determines if you will be subject to IRMAA and how much you have to pay. This is basically an extra tax, but there are circumstances where it may make sense to pay it. So consider a situation where you have a married couple with income of $200,000, which means at that level, they don't have any IRMAA yet. There's no extra Medicare premiums. Let's say they also happen to hold some stock that they purchased for $450,000 and the current market value is $500,000. So if they sold, they would realize a capital gain of $50,000. That pushes them into the next IRMAA tier, and that would cause them to pay about $1,800 for the year in extra Medicare premiums. Obviously, no one wants to pay an extra $1,800 if it's avoidable, but it may not be worth continuing to hold a $500,000 investment, especially if it's over-concentrated in your portfolio, if it's overvalued, it's risky, or anything like that. And an extra cost of $1,800 is really less than 0.5% of $500,000. So any market volatility has the chance to wipe out much more than $1,800. We see people all the time who are so concerned with IRMAA or paying taxes, and they never want to sell anything, but in the long run, that can cause them to lose a whole lot more money. So sometimes the best overall decision while weighing your investment and your tax situation is to take profits and move on.
And Harrison, is this something that somebody's age would affect it at all, or is it just based on dollars?
Well, to be on Medicare, you have to be 65, right? So that means if you're age 63, your income for that year is going to determine what your Medicare premiums would be at 65. So anybody over the age of 65, every year really should be looking at their income level and determine, are they close to one of those tiers? IRMAA has 5 or 6 different tiers, and depending on your income, you might pay more or less. The first one starts at income for a married couple of about $215,000. So if you're under that, you don't trigger anything, but once you go above that, you start to trigger it. So it's mainly, what's your income level, but when we look at it from the investment side, percentage-wise, those extra Medicare premiums might not be much compared to the investment dollars that you deal with. So, when you're paying IRMAA, you see the dollar amounts withheld from your Social Security check, and it's like, geez, there's an extra $185 a month. I hate that. But if you compare that to a portfolio that's, hundreds of thousands or millions of dollars, you kind of have to take it with a grain of salt to see sometimes it is better to pay slightly higher premiums if that means you can de-risk your portfolio or, even out your capital gain situation or whatever that is.
Yeah, I know one thing too that we talk about is obviously the capital gains tax rate on the federal side for long-term gains is 0, 15, 20. I believe, I don't have the number here, but the 15% range is quite large.
It starts for a married couple at taxable income of about $96,000. So that's taxable income after your standard deduction, itemized deduction, and then that goes up to this year like $600,000. So basically, from 100 up to 600 is that 15% bracket. So it's really large. And so people look at capital gains and they're like, well, if I have to sell it, I've got a 15% capital gain tax. And it's like, well, you might be in that bracket forever because your income is always going to be between $100,000 and $600,000. So it's not like you can defer until some point in the future and realize gains at a lower rate. You might always be at that 15% rate. So you need to understand that as well.
And I could be wrong here, but I know you talk about it a lot. You look at it for your clients. I'm wondering how concerned the tax preparer, the CPA doing people's taxes, really look at that. And I don't know. Maybe you know. Maybe you don't know. But it seems like for you as a certified financial planner, it's very important to look at that as a thing for the investment side.
Well, when you look at a 1099 from an investment account and it has your dividends, interest, capital gains, it does not include the market value of the portfolio. So sometimes a tax preparer will be like, you had $20,000 in capital gains. Why'd you do that? We're paying tax on it. And it's like, well, we might have a portfolio of $5 million. We're going to have some income taxes. I'm sorry. There's no way to realistically avoid that without just having an unnecessary amount of risk. So when I look at it, I'm looking at, well, how big is the account? What does our income look like? How is income going to be changing? What different sources are they? What is a reasonable amount of income to have on a year-to-year basis so we're not unnecessarily triggering anything, but also, in some cases, paying a little bit of tax is the right thing to do overall. So I look and kind of weigh all of those things on a year-to-year basis.
And I know we've mentioned this on the show, but I think that obviously this is a timely topic because, Brent and I were looking at our portfolios today, and we pretty much pushed a lot of our clients now about a 20% allocation to cash or high-yielding money market, which we've talked about this before, but I'm very confident that is the highest allocation to cash we've had in my time with you, so since 2015.
And I believe it's the highest cash I've had since 2008 when I was concerned about the Great Recession.
Yeah. So and that's kind of where, again, Harrison's topic of potentially looking at gains, it might not be as bad as you think, especially given where the valuations are.
Yeah.
Right. And it doesn't mean you want to, again, don't do it just for the heck of it. You don't want to disregard it, but you have to, understand, relatively speaking, what is the overall cost of this from a percentage basis. And, if you're very close to it and you can stay under that threshold, okay, great, go ahead and do that. But in other cases, that's just not realistic. So, weigh that. Like I have business owners that are like, I don't want to trigger IRMAA. I got to find $20,000 of expenses to avoid that $1,800. And it's like, don't spend $20,000 to save $1,800. See the big picture here.
Right. So, all right. Well, Harrison, thank you very much. You have a great day, and we'll see you on Monday.
Thanks, guys. We'll see you Monday.
Okay. Again, that's Harrison Johnson, our CFP, our financial planner at Wilson Asset Management. Give him a call at the office, 858-224-0004. Stay tuned. We'll be right back after this break. All righty, welcome back to Smart Investing Show. And that song, Sailing, that was a song that when I got out of college back in New York, I heard it and I would dream about coming to San Diego. That was back in 1985.
Wow.
Yeah, so
history.
Yeah, when I hear that song, I'm like, oh yeah, it always made me so calm. All right, let's talk about some companies here. We're talking about Moderna. And this is one that's been in the news a lot over the last 5 years. They're great on COVID. I know Chase will probably cover a little bit more on this, but Moderna is one we're looking at to see if there's some value here. Stock has a major hit. But company is Moderna, symbol mRNA and biotechnology. 14% short on the float side, so that's pretty high. 72% institutional owned. no PE ratio, which means they have no earnings over the last 12 months. Price to sales look good, 2.6 versus 7.7. Price to book value, 1.1 versus 0.9 for the industry. No price to cash flow, no PEG ratio, so those are disappointing. Look at the past year, no earnings at all, so it means they probably had no earnings for the past 2 years. Industry had earnings that were down 30.1%. Kind of worried about biotechnology. We don't look at it very often, but that doesn't even look good, the industry. Sales Moderna, well, they fell by 25.1%. The industry was down 5.9%. Got to make sure I can see this number right because it's such a crazy number. The 5-year earnings per share growth estimate from the analyst for Moderna, down 51.3%, so not much of a future. The industry's down 1.9%. They don't pay a dividend. Look at the balance sheet here. They do have a good balance sheet, though. A current ratio of 4.4 versus 5.9. Shows a lot of liquidity. They can pay their bills. Debt to equity very low as well, 0.1 versus 1.6. We do see a net profit margin of a negative 44% versus a negative 15.2. And I do believe this company's probably had some major write-offs to have such a negative profit margin. Return on equity, also a negative 18.6 versus a positive 6.5 for the industry. Gosh, I mean, this could be a value, but Chase, you got to change my mind on this because right now I'm not seeing anything good.
Yeah, well, kind of want to start here. The reason I thought this was interesting, I mean, the stock recently fell about 20%. I think it was, they closed down 17% here recently in one single day. I mean, the company had
20% one day?
Yeah, wow. 17% to be exact. 16.8 if you want to get precise.
Okay.
But the company actually projected $3 billion to $3.1 billion in sales of its 2 products. Keyword there. Two products, which is below its previous call for $3 billion to $3.5 billion. So they cut the high end of the guidance. Moderna does have its COVID vaccine and then also a vaccine to prevent RSV. Those are the 2 products there. They also cut its 2025 outlook. That seemed to be a big problem and now projects just $1.5 billion to $2.5 billion, which was well below its prior view for $2.5 billion to $3.5 billion. So that's why the stock fell dramatically. I was like, I mean, maybe there's an opportunity here. I did want to say, talking about the stock falling, obviously it fell just about 17% in one single day, but I'll give you the numbers here, and you can kind of see how much it has fallen. The current price for Moderna is $34.06. The 52-week range, $31.94. The high here, $170.47. Wow. That's not even the crazy part. You go back to 2021 when things were really booming for Moderna. It reached an all-time high on August 9th, 2021, $497.49. I mean, this stock obviously has just been crushed. Pre-COVID, I mean, the stock was around, I think it was around $20-ish. Yeah, it was right around like 18, 19 in December 2019.
And I got to bring up again, I mean, that's the COVID thing. We always talk about this, about people being tied into the hype. And you said it was the high during COVID, 400 and something?
497, almost 500.
Almost 500. Now it's at $34 a share. Never, ever buy hype because it eventually leaves. And you also mentioned now 2 drugs. One is a COVID drug, which I don't imagine is making much in
I mean, I think that's why they cut guidance so dramatically.
Yeah.
I'd have to assume. I mean, it's definitely not what it was in 2021. So
well, I'm excited to hear the earnings going forward, if there are any.
Yeah, I mean, I was kind of disappointed. I thought maybe there might be something here just because the stock has done so poorly. I mean, generally we like to step in and buy things kind of once the hype fades. And I was like, maybe this is time now to look at a business like this. You know, Zoom, kind of getting off topic here, Zoom was another one that went way up and way down. And actually looking at the numbers, Zoom actually had some earnings. Unfortunately, Moderna does not. Estimated to lose in 2025 $8.93 a share. Can't even derive a target sell price off that. So, unfortunately, Moderna, even with the massive fall, still wouldn't fit our criteria to consider it as a buy.
And actually, I do see those earnings have been falling over the last 90 days. I mean, there's just nothing good with us. And also, it could become a one-trick pony because if COVID's not doing very much, I think you said, was it RSV? That would be the whole thing. And you should never invest in a company with just one drug, maybe even 2 drugs, because it's just, you know, you get disapproved or you can have a lawsuit against you. I mean,
I don't know what their pipeline has either. I mean, they could have some promising things in the pipeline, but I mean, if you're buying it for that, that's pure speculation because, I mean, good luck guessing that knowing what the government's going to do and the FDA is going to do in improving new vaccines.
Well, and that's why we look at the mean estimate of the analysts. And again, I see 21 analysts on that. So it's not like they're sitting in a booth not knowing anything. They know the pipeline as well, and they're just not seeing anything at all from Moderna. So don't be sucked into that low price of, was that $34 a share, whatever I think you said?
Yeah, 34 is the current price.
Yeah.
And I mean, but kind of going back to the analysts, I mean, even with 21 analysts, the low estimate's $10.35, a loss of $10.35. The high estimate, still not even good. A loss is $6.76. So even the most optimistic is not optimistic.
If you're brave, you can maybe short it, but we don't recommend shorting.
No, I'd be very careful of that.
So, well, let's move on to Signet Jewelers, and they're a big jeweler because they've got, I think, Kay's Jewelers. I mean, you might be a habit. They've got many different brand names.
Yeah, brand names here: Kay Jewelers, Zales, Jared is another one.
Oh yeah,
what's the tagline? He went to Jared. All his commercials, and then Blue Nile. I think you actually didn't you shop at Blue Nile?
That's where I got my wife's engagement ring years ago, and back then they were not here in California, so I paid no sales tax.
Wow!
But they still had great prices. I mean, I got a very good deal.
Because they're a pure internet retailer. So there's no stores, I don't believe.
There used to be. Now there's a up in Newport, I think it is, where they got that fashion island. There is a actual Blue Nile store there. And what that ruined was now you got to pay sales tax and whether you buy online or not. But anyways, you still get good prices there. Yeah. But let's talk about if it's a good price on the stock here. Again, Signet Jewelers, symbol SIG. They're in the luxury good industries. Wow, I'm surprised on this. Short of the float, 22.6%. That's huge. There's somebody seeing something really wrong with this company. I didn't know there was anything wrong with it, but that's why we're looking at it for you. Institutional ownership, 109.1%. That's because of the shortness there. Now, you've got a good PE ratio, 6.7 versus 28.7. Price of sales, 0.4 versus 3.3. Price to tangible book value looks good, 3.1 versus 14.9. Price to cash flow, 4.8 versus 16. And the PEG ratio going forward, very good, 0.6. And the lower the number, the better. So that's a very good number. Look at the earnings. They were only up 0.1% over the last year, but the industry was down 3.9%. Sales declined by 6.7, which was worse than the industry decline of 5.7. But the analysts on their 5-year earnings per share growth estimate is pretty good, 8.2%, almost 3 times the industry at 3.3. I also see they pay a nice dividend of 2%, only use 10% of the earnings to pay that out. And then look at the balance sheet. You got a current ratio of 1.6. That's below the industry at 2.4, but 1.6 is not bad. And then debt to equity, 0.8, same as the industry. That's okay. Net profit margin, 8.6, just under the industry at 10.8. Return on equity, very good, 26.8 versus 21.8. So I don't know if you have some special news on this, Chase, but I mean, I'm seeing things looking pretty good here. What am I missing?
Yeah, just kind of the reason I was intrigued by this one was looking at the 5-day stock price movement is down 24%.
Wow.
They had a huge fall. They actually came out with holiday shopping numbers, and same-store sales were actually down 2% year over year for the holiday period. Definitely below what people were looking for. The estimate for Q4 for Signet was for revenue of $2.32 billion to $2.34 billion. That now that's what they now see Q4 to be. The initial consensus estimate was $2.42 billion. So there was a big cut for such a small amount of period, obviously, in Q4. Also, too, they cut EBITDA down to $381 million to $391 million, which is down from a prior forecast of $441 million to $471 million. So I'm curious if we're going to start to see earnings estimates decline here a little bit. But I thought this was interesting. They said that bridal and kind of engagement rings that was actually doing pretty well. It was fashion gifting that underperformed. So I guess
what is fashion gifting?
My guess would just be your wife wants new diamond earrings, wants a diamond necklace. Just kind of just normal jewelry, okay. not the lifestyle milestone moments like getting engaged and so forth. So
let's do the numbers, and I want to talk about that more because I got some questions, but Let's go to the numbers.
Yeah, let's look at numbers here. Current price here for Signet Jewelers is $57.48. Again, their ticker symbol is SIG. I talked about the struggles over the last 5 days, but the last 52 weeks have not been kind to Signet either. The 52-week low is $54.44. The high here, $112.06. So it's definitely been struggling over the past year. I will say from a valuation standpoint, I mean, it looks pretty promising. I mean, you go out to January 2026, estimated earnings per share here, $9.28, gives us a very lucrative target sell price of $154.05. I mean, the valuation is slightly over 6 times those future earnings.
That is very low. And I do see that the earnings estimates for the last 9 days are down about 13%. But I think that's overdone based on what I'm hearing and what I'm seeing. And I show on my screen, it shows 9.75 for February 26. But still, you said the PE ratio going forward is 6?
6, yep.
I'm kind of lost for words. That's a great buy. And I don't see what would be wrong with it. And yes, I think the hype was there, maybe brought it too high, and now the disappointment with the holiday sales. But going forward, I think this could be a good buy.
One thing that concerns me with this company, and I've never understood the exact reasons and how it works. Obviously, I'm not I'm going to say an attorney, but they do file in Bermuda is their headquarters.
Okay.
One thing that concerns me with this is we kind of saw during COVID a lot of the cruise lines, they were not domiciled here in the U.S. Well, people were like, well, they don't get any help then because they're not domiciled here. My concern is I don't know how much they get overseas. I would think this might be a prime target for tariffs, and I don't think President Trump would be very kind to them because they're not domiciled here. So I think that kind of sounds funny, but I don't know what the benefit to headquartering in Bermuda is, but that scares me a little bit.
I used to know years ago, and it hasn't come up in a long time. There's a reason why companies do it. I forget what it is, so I apologize. But I still think if you can look at, and I think it's definitely worth looking into because I think this could be a screaming buy. Look at where they're getting the diamonds from. Could they be coming from Africa? I think
those are blood diamonds. I don't know if those are. I think that took a lot of flack. I'm not sure if that's still where they get them or how that all works. I mean, I don't know much about the jewelry space, but you definitely need to again understand their sourcing because I mean, diamonds are hard to find. It's not an easy thing.
And they do have the man-made diamonds now, which I guess they're saying they're very, very close, and therefore it's hurting the real diamonds. So maybe that's the other issue is that these man-made diamonds, they say you cannot tell unless it's a 10-time microscope or something.
Yeah, I'm a big fan of the lab-grown diamonds.
I am too. You can't tell the difference.
I purchased some for Christmas time. So
okay.
Well, and they look beautiful. I mean, and definitely weren't too expensive.
And you got to tell somebody if it's real or not. And who cares if it looks nice? It looks nice. And but I think it's still worth looking into. But you've got, and this is why we always talk about this. This is why we tell people it takes us 10, 15, 20 hours before we buy a company because we want to understand what is going on with Signet because it looks good, but you could be wrong.
And I'd be surprised if they didn't have a lab-grown diamond division within Signet. But I'm not sure what the margins look like. Was it a higher profit margin on non-lab-grown and now introducing these lab-growns is dinging the overall profit margin? I mean, so there's a lot to be answered here. But as you said, I mean, it's intriguing. And
the profit margin could be the same, but if a real diamond is $10,000, you have a 20% profit margin. That's $2,000. You sell a man-made diamond for $5,000, 20%, that's only going to be $1,000. So your profits could be cut in half. But again, the analysts going out, they know that. So I think I would want to know a little bit more about the company. But I think I'm going to put a buy with research on this because I like this company. I like the debt level. Everything looks good on it. But you got to find out what is going on. I think it could be an overkill here.
Also, what malls are they in? Because obviously mall traffic, and I actually did hear that Gen Z, which is the demographic that's younger than millennials, they are kind of avid mall goers. So maybe mall traffic will start to pick up. I don't know if Gen Z is necessarily Signet's target audience, but they'll be getting married at some point, so maybe they are. But my point being is what's going on with mall traffic. I believe that's where a lot of their sales come from.
And actually, I read, I think it was a week ago, that open air malls are actually doing very well. So it's your older closed-end malls that aren't doing well. Open air malls, They said they're booming. So, all right, well, let's move on to our next company here, Teladoc. TDOC is a symbol, and this was also another one that during COVID was just a huge gainer. They're in the health and information services industry. No, I think every company so far has had high short on the float here, 19.8%. Institutional owns 77.2. No PE ratio, no earnings for this company, same as the industry of health information services. Price to sales looks good, 0.6 versus 2.7. Price to book value, 1 versus 3.9. That's positive. We do see price to cash flow, 4.5 versus 25.4. No PEG ratio. No earnings over the last year versus 19% for the industry. Their sales are down 0.5% versus a gain of 20.8 for the industry. 5-year estimated growth from the analysts, wow, a decline of 29% versus a gain of 12% for the industry. They do not pay a dividend. Look at the balance sheet. Current ratio 1.7 versus 3.5. I mean, it's not as good as the industry, but that's okay. Debt to equity 1.1 versus 0.9. Yeah, no problem there. Net profit margin, however, could be write-offs, could be something else, but a negative net profit margin of a negative 37.9 versus a negative 3.2. Return on equity, oh my gosh, a negative 65.1. Gosh, Chase, things aren't looking good here unless you got something good going forward.
I kind of went off on a tangent because I told our listeners, I was like, it's kind of like Zoom, where Zoom actually had profits, and I'm like, I just want to make sure Zoom actually does have profits. Okay. They trade for like 14 times future earnings. I'm not saying go out and buy Zoom, but that was one of the COVID darlings that obviously went way up, went way down, and maybe could justify some research from a value perspective because they do have a profitable business. We'll now look at Teladoc, though, as that's where we were. Their ticker symbol is TDOC. Current price here, $9.09 at 52-week range. Stock has not done well, to say the least. The low here, $6.76, and the high, $21.74. Kind of like Moderna, I thought it'd be fun to look back to its COVID high. This one came February 15th, 2021. $308 is where it hit its all-time high.
Let's buy the hype. Let's buy those growth companies. Yes, let's get on those.
Yeah, and this one I thought was interesting. I mean, I thought, again, maybe you could find something here because it has just been beaten up so drastically, and this business actually too, they did come out and they announced a new partnership with Amazon that's meant to expand patient access to Teladoc's cardiometabolic programs. Amazon customers who are eligible for Teladoc Health's virtual diabetes, hypertension, prediabetes, and weight management programs will now have the ability to discover and enroll in these benefit programs through Amazon's Health Benefit Connector. Maybe this will help the business because obviously Amazon's got a lot of loyal customers. Yeah. But going forward, I don't know if that's going to be quite enough to justify a buy. It's just I look forward for this business to go out to December 2025. Estimated earnings, there are none. They're still estimated to lose $1.03, so no profits again for this business, unfortunately.
And I can see why this was big through COVID because people didn't want to see people. They want to stay home. But I still like, and today when I call my doctor, like, do you want to be in person or do you want to do it over the phone? No, I want to be in person. I like to look at someone and talking to them and really be able to look at the same thing. So it just doesn't make sense in normal times, Teladoc. And I remember during COVID, like, oh, this is the next big thing in medicine. It's going to be great. It's going to grow forever. Like, no, I still think when this thing is over, people want to talk with people face to face.
I don't know about you, but I'm just terrible when they're like, is it a shooting, a stabbing, what are
you talking about?
Like your pain when they're like, what type of pain is it? Is it shooting or stabbing or I forget the other ones?
I thought you meant shooting with a gun or stabbing somebody.
And I'm like, I don't know. I don't know how to answer the question. So I'm like you. I don't like to do this because to me, like even doing it over a video conference or whatever, it's not much different to me than doing it over the phone.
Right.
Again, especially if you have like a bump or something, I'm like, I want the doctor to feel it. I don't want to be like, yeah, can you see that bump in the camera? So I agree with you. I just think it's maybe got way overdone during COVID, and maybe it's an acquisition target. I don't know. I thought maybe when I saw the Amazon news, maybe Amazon could acquire a company like this, but the numbers would have to make sense, and I don't like to speculate over acquisition targets, just kind of trying to put that out there again for our listeners.
Yeah, and there could be some use for it for some people that are elderly to try to get out. It might be easier for them, but it's just not going to be a big money maker. And I think you're right. Maybe Amazon can do something with it because they do have such a wide base of things. I mean, Amazon can almost do anything because they got such a wide base of members.
Yep.
So, well, let's move on to Qorvo. Am I saying that right? Qorvo.
That's how I'd say it. I'm going to go with that.
Okay, well, let's go with Qorvo. Did I put the symbol in? Let's see. Yes, I did. Or did I put? Yeah, I did put Qorvo in. They're in the semiconductor industry. Well, finally, a company with not a lot of short on. But sometimes a lot of short can be good because it can give you some value opportunities. 91.6% institutional owned. Again, no PE ratio versus 66.6 for the industry. Price of sales 2.1 versus 12.6. Price to book value 15.1, but the industry is over 500, and that's price to tangible book value. Price to cash flow 8.9 versus 35.5, and the PEG ratio going forward 4.4 versus 13, so Qorvo wins on that one. You want the lower PEG ratio. No earnings over the last year. Industry was up 21.4. Sales climbed by 14.1%, which is pretty good. But the industry, well, that was up 111.3%. I think it's probably a lot because of NVIDIA. 5-year growth rate, only 3.7 versus 36.1 for the industry. They do not pay a dividend. Look at the balance sheet. Current ratio 1.9 versus 3.2. That's okay. Debt to equity 0.6 versus 0.3. That's okay. Net profit margin checks in at a loss of 3.6% versus 21.2% positive. And return on equity is a negative 4.1 versus a positive 55.8. Jace, what do you got?
Yeah, so I'll give you kind of the numbers here first and then kind of interesting background on Qorvo. But the current price here is $84.21. 52-week range, the low here is $64.54. The high, $130.99. Again, their ticker symbol, if I didn't get it already, QRVO. But going forward for Qorvo, we go out to December 2025. We see estimated earnings per share. Oh, actually, I'm sorry. They report on a fiscal basis, not a calendar basis. So we go out to March 2026. I see estimated earnings per share, $6.13. I mean, it gives us a target sell price of $101.76. So it's not, I would say, egregiously overpriced, and it's definitely below the target sell price. I think this might be in our hold category, though, as it does trade now at, trying to do some quick math here, does trade at
13 times?
13 to 0.7 times those future earnings. So it would be in our hold category. I bring this up because the stock went up 14.4% on Friday's trading. Starboard Value, they built a 7.7% stake in Qorvo, so the market seemed to really like that apparently. But the thing that I look at this company that concerns me, I was reading some further research on it. It says the Apple supplier, so they're tied to Apple, which we know Apple's been struggling with handset sales or smartphone sales.
What? Apple struggling? What? How can that be?
But they've been grappling with stiff competition and slowing orders for its smartphone chips as consumers gravitate towards entry-tier smartphones, while larger rivals such as Broadcom and Qualcomm benefit from a recovery in the Chinese smartphone market. So it looks like, obviously, they're competing as Broadcom and Qualcomm. I'd be curious, I guess, on the dynamics between that competition, because those are pretty formidable competitors. But also, too, in October, Qorvo said the shift away from mid-tier 5G Android smartphones will impact its revenue in the second half of fiscal 2025. The company is expected to report a 16% drop in third quarter revenue as per data compiled by LSEG. So I think this business right now might be in a little bit of a difficult situation. I don't know if it all comes from handset or smartphone revenue or if they have other revenue streams, but that could be a little concerning. In particular, they talk about Apple being the Apple supplier. How much of that revenue comes from Apple? Because all of a sudden Apple was like, actually, we're going to go back to working with Qualcomm, Broadcom, and we don't need you anymore. That could be detrimental to this business.
And that's one thing we look at is that you don't want a company that they have like 30-40% of the business comes from one company, especially like Apple, where all of a sudden you're gone, gosh, and take a big hit. We don't know what that answer is on Qorvo, correct? But if you're looking at investing into it, watching it, what I would do is understand that question. How much of Apple doesn't make up of Qorvo's business? Because if it's too high a percent, just too risky. You can't take that risk. And I think you mentioned competitors would be Qualcomm and somebody else. So very competitive industry, and I mean, other than that, it looks okay, I guess, but I don't think I'd waste any time on it.
Here you go. Here's
You got it?
I'm using AI. I'm high tech now. Google's Gemini.
Wait, how much you paying for it?
Well, using Google's Gemini, I just did a quick Google search here. It says Qorvo's major customers include Apple, Huawei, I was kind of surprised by that, and other smartphone manufacturers, defense companies, infrastructure companies. Apple, Qorvo's largest customer, accounting for over 1/3 of its revenue. So that's a big risk.
That is a big risk.
And I think his name is Jeff Smith. He's the guy at Starboard. I've liked some of the things that he's released with some other of his activist trades.
Right.
So I'd be kind of curious to, I guess, see what value that they think Starboard can add, because that's the whole point of an activist firm. It's not just like, oh, we're buying this company for a passive reason. They think that they can go into that business and then improve it, get some multiple expansion, and actually really enhance what the company is doing to generate a good return on their investment. So I'd be curious what his slide deck looks like for what he thinks that they can improve within Qorvo.
And not if you heard or not, but Hindenburg, who we've used before, that they're really sharp on their research, are actually closing the CEO or the head of it. I think he's just tired.
Yeah, it's a hard job, I'm sure. So, I mean, it's
a big loss, though, because he really looked into companies deep and found things that other people wouldn't find. And he wasn't just he was a short seller, but their firm really did the research to find out these things that other people couldn't find.
Yeah, and I mean, we've never shorted anything, so we never utilized it, but he always made some interesting points, and we've kind of used him, I think, 3 times in the last year, because he's had some really interesting takes.
Well, and it's nice to look, if you're looking at investing in a company, what does he feel about it?
Yeah.
Wow, closing bell came early, it seemed like, but thanks for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. You can listen to the podcast. You can also sign up for the newsletter there. Go to YouTube, The Smart Investing Show. See all our videos are about 2 minutes long, about 10 a week for you there. Thanks for listening. We'll be back next week right here on The Smart Investing Show.
I did all